Welcome to the deep dive. Today, we're unpacking a really complex topic, but giving you the essential insights you need. We're talking about setting up and running a compliant U.S. business as a non-resident. The U.S. market, huge opportunities, right? But the regulations? They can definitely trip you up if you're not careful.
That's exactly right. So many international founders, they hear about these sort of quick and easy paths, but then, bam, they run into major compliance problems, serious penalties too. So yeah, our goal today is really to demystify the whole process, guide you through those first big decisions that honestly shape everything else.
Okay, let's unpack that first one then. Setting up shop in the U.S. The legal entity. That's the biggie, right? I mean, you often hear LLCs are the simple way to go. Is that actually true for non-residents? Or is it a bit of a myth?
It's definitely a myth and potentially a dangerous one for non-residents. So the main choices you have are the C corporation or the LLC, the limited liability company. Now the C corp, think of it like a separate person for tax purposes. It files its own return. That's Form 1120, pays its own tax, a flat 21% federal rate. For you, the non-resident owner, your U.S. tax headache is usually just a withholding tax on dividends, maybe 30%, often less because of tax treaties. And crucially, if the C Corp doesn't pay dividends, you likely have no personal U.S. tax filing to worry about.
Ah, okay. So that sounds cleaner.
Much cleaner. And that's exactly why venture capitalists, institutional investors, they pretty much demand a C Corp structure. It's just standard for funding.
Right. So back to the LLC then. Why is the simplicity idea so misleading for someone outside the U.S.?
Precisely because of how it's taxed by default. An LLC is usually a pass-through. It's profits, it's income, it flows directly onto your personal situation. So if you're a U.S. business, your LLC makes what's called effectively connected income or ECI.
Which is income from actively doing business in the U.S.
Exactly. If it generates ECI, then you, the non-resident owner, personally have to file a U.S. non-resident tax return. That's the Form 1040-NR. It's not simple, and there's more. A foreign-owned single-member LLC, just one owner outside the U.S., has a very strict reporting rule, Form 5472.
Form 5472. What's the big deal there?
The penalty. Fail to file it or file it incorrectly, and you're looking at a $25,000 penalty per year, even if zero tax was actually due.
Wow. 25 grand just for a reporting form.
Right. So you see why the C Corp, counterintuitively, often ends up being the simpler, safer compliance route for foreign founders. Oh, and just quickly, S Corp, generally not an option. They can't have non-resident alien shareholders. So C Corp or LLC are the main paths.
Okay, that distinction is crystal clear now. C Corp generally cleaner for non-residents, LLCs create personal filing duties, and that huge 5472 risk. So, say you've picked your entity. Next up, where do you incorporate? Does the state actually matter much? Seems like just an address.
Oh, it matters a lot. It really depends on your long-term plans. If you're aiming for venture capital, big growth, Delaware is king. Over 65% of Fortune 500s, almost all VCs are there. Sophisticated corporate law, predictable courts.
So if VC funding is even remotely on the horizon, Delaware C Corp is almost a must.
Pretty much, yeah. They'll likely make you reincorporate there anyway if you start elsewhere.
Yeah.
But if your goal is different, maybe e-commerce, consulting, something where privacy, asset protection, low fees are key, then Wyoming is often the leader. Wyoming offers strong privacy. You can have anonymous LLCs there, and the annual fees are super low, like $60 sometimes.
Delaware for VCs, Wyoming for privacy, and low maintenance. Got it. Okay, entity chosen, state picked. What about the essential numbers, like getting that tax ID and the big one, banking from overseas?
Right. Every U.S. business needs an EIN, employer identification number. It's like the company's social security number, issued by the IRS. For non-residents, calling the IRS is usually the fastest way to get one. And here's a point that trips people up. You generally do not need a personal ITN, that's an individual taxpayer ID number, just to form the company or get the EIN.
Ah, okay. So you only need an ITN if?
If your structure, like that default LLC we talked about, actually forces you to file a personal U.S. tax return, then you'd need an ITNN for that return, but not usually for just setting up a C Corp or getting its EIN.
Makes sense. And banking, that used to mean flying to the U.S., right?
Historically, you absolutely had to show up in person. Some traditional banks still want that. But now you've got fintech options. Platforms like Mercury, Wise Business, they often let you open a U.S. business bank account completely online from abroad.
That sounds convenient. Too convenient. Is there a catch?
The catch is scrutiny. Because it's remote, they do intense Know Your Customer, or KYC checks. You need to prepare what I call a KYC dossier. Get all your documents ready, formation papers, the EIN confirmation letter, your passport, and crucially, strong proof of a real U.S. business purpose. like a detailed business plan, contracts with U.S. clients, supplier agreements. They need to see it's legitimate.
Okay, so be prepared for a deep dive into your business legitimacy for online banking. It definitely sounds like there are traps for the unwary, especially around tax and reporting. What's the absolute biggest red flag or warning you'd give non-residents?
Without a doubt, it's back to that Form 5472, the $25,000 penalty form. Remember, it applies to U.S. corporations with 25% or more foreign ownership and to those foreign-owned single-member LLCs. And what triggers it? Reportable transactions with a foreign owner. You know what counts as a reportable transaction.
Let me guess. Something simple.
As simple as you, the owner, putting money into your own company. A capital contribution. That's a reportable transaction that triggers the Form 5472 filing requirement for an LLC.
Wow. Okay, so just funding your own business requires this high-stakes form if it's an LLC.
Correct. And it shows how everyday business actions can create unexpected, complex U.S. compliance duties. Here's another one. If your U.S. company opens a bank account back in your home country and the balance goes over $10,000, that U.S. company now probably has an FBAR foreign bank account report filing duty with the U.S. Treasury. It's a web of rules.
Okay, this deep dive has really highlighted the complexities. The opportunity in the U.S. is massive, no question, but navigating the rules correctly is absolutely key.
It really is. And remember the core takeaways. Structure drives simplicity. For most non-residents, the C Corp is often cleaner. Be ready for banking scrutiny. Get that KYC dossier tight. And above all, know your filing deadlines, especially for things like Form 5472. The penalties are just too severe to ignore. My strongest advice. For non-residents, always aim to over-comply rather than under-comply. Get specialized help. Talk to a CPA or an attorney who genuinely understands international U.S. tax and corporate stuff. It's worth the investment.
That's really powerful advice. Getting it right from the start seems crucial. This gives you, our listeners, a much clearer roadmap, hopefully. So the question now is, with this understanding, what new opportunities might open up for you? Keep exploring, keep asking questions, and join us next time on The Deep Dive.